Hey everyone, this is the Trader Investor, and I'm coming to you with a video to show you a new strategy, new to you that is different than the one I shared over the weekend. So last Saturday on March 27th, I shared with you a 14 minutes a day trading strategy using Fibonacci retracement. Today I'm going to show you another strategy which can be done in 28 minutes a day and no more than that. But for this one, I use the 30 minutes chart and I use the Fibonacci retracement for my exit criteria. But for my entry, I use the MACD for divergence. So the first thing I want to do is I want to show you the settings of my MACD. So I want to show you that setting so that it helps you understand how I'm looking at it. So the fast length, I set it to 8, slow at 21, and I keep the signal smoothing at 9. The 9 is the default, and the source, the close, the default. So I'm not changing that one. And also the time frame, I use it the same as the chart. I'm not changing that one. The other thing I've done is I have removed the histogram. This is just noise for this particular trading style. And the signal is also noise for me, so I have removed the signal. I'm looking for a specific setup of the MACD in conjunction with the charts that will help us identify turning points. So the signal crossing up, crossing down is very insignificant for this particular case. So that's really what I'm looking for as a setup. So one more time, 8, 21, 9, close, same as chart, nothing changes. Style, remove histogram, remove signal. We want to make it as little confusing as possible. So that's the key part. The other thing that I do is every time I get to a new chart, I draw a new line for the zero line. I just want to see where it is in relation to the zero line. That's really not that important. The most important part we'll get to as I show you how I use this strategy and how I do it for just 28 minutes a day. First, let me explain how the 28 minutes are derived. Cash market hours are 9:30 a.m. to 4 p.m. Eastern time. So between those hours are the only time that I want to trade this strategy, mostly because I use options. Because I use options, I only implement it during the cash hours. That's number one. Number two, I use it on just the four indexes, the SPY, the Qs, the IWM, and the diamonds. This is just the four that I use it on, but you can use it on any instrument that you like. Just make sure that the signal lines, the MACD line is really well understood and that you can manage it in terms of the 8, 21, and 9. So does that really work for your particular ticker that you are managing? That's the key part you want to make sure you're doing. And so so we have the fours, we have our MACD set up. The volume is just for confirmation to overall. So what I want to do is I always look at save. I always look at save as my starting point. Where is the structure? The current structure is in an uptrend, downtrend, sideways. That's the structure, and potential areas where structure could be broken. And then where's the area of value? Where is price coming to take advantage of short-term pullbacks for the next leg up or short-term rallies for the next leg down? So I want to make sure that I see the area of value, and then I will execute based on the structure and area of value. So for the four indexes, I know we're in an uptrend. Without going into that analysis, daily, monthly, weekly has shown me we're in an uptrend and we're having some pullbacks. So then how do I then take advantage of the MACD and the pullbacks? So I'm going to go back to time here and I'm going to show you. the different things that I look at. So every 30 minutes at the close of each bar, I look where bar stands. So if it has made a low, then I will zoom out here. So if price has made a low, I want to see where that low is in relation to previous lows. So it's not lower than previous lows, in the last couple of days. So really in this day, there is no signal for me. Now the following day, we're almost at an equal low, but then, is the MACD any different? Does the MACD show anything different? That's the one thing I want to take a look at, just to make sure that the MACD is not, confusing, is not making anything different. So looking at this trend, price is making a higher low, MACD is making a higher low. So nothing complicated there. So that goes on. I'm going to start with showing you how we buy call puts, call options, and then I'll show you why I choose not to do put options at this moment. So let's just focus on the call options for now. So then as we move in time, then I see here price has made a low, price made another low, but the MACD is also moving in the same direction. So nothing to be done here. Then I come here, I see price has made a low, but from previous low, and the MACD now is not in the same direction. It is slightly skewed, slightly, but not a whole lot. But it doesn't matter. To me, what I want to look at, even if they make equal lows, I still consider this as a divergence. What I want to see is something like this. This is what I want to see when price moves this way. I want the MACD to move this way, right? So here it has done that. When you look at this and this, it aligns with this movement. But now when we change to here, now that does not align with this movement. So now that tells me it's time to look at going for on the long side and buying a call option. So where do I enter and how do I enter it and how do I manage it? What I want to see is the bar that made the low. When we break the high of that bar, that's my entry. So this is my entry. This is my stop. I'll make it a different color here. This is my stop. This is my entry. This is my stop. Now, where is my exit? How do I set my exit? So what I do is I draw a Fibonacci retracement from current high to low. And at the 100% is my exit 1. This is 50% of my position is taken off at 100%. So from this entry here, from this entry to this exit. So this is a little bit one-to-one. So I prefer it a little bit better than one-to-one, but this is one-to-one. That's where it is for this particular entry. So I enter here, I have a stop here. This is my exit 1. Then what happens is as price moves higher and higher, my stop loss is now moved. My stop loss is now moved. So every time I cross this was my stop. Now I've crossed this is my stop. And depending on how many contracts I have, depending on the timing, like is it end of week or not, I might take off the rest of my 50% positions here at the 1 to 7 2% extension, I might do that, or I might just trail it using these fib levels. So just to recap on the process, I look for divergence, I look for price to make lower lows, and there's a divergence. Once that divergence pin is broken, I enter. 50% of my position is exited at 100%, and the rest I trail it, or I just do a 1 to 7 extension. So let's take another example. Let's stay in the spice for now and take another example. So between here and here, I want to see, is there divergence? So price has gone here, and price and MACD has gone here. So I don't see any divergence. So I move on. There's no trade for me there. This is where the 28 minutes a day come into the picture, because all I'm doing is a couple of minutes every half hour. I just take a look at this chart, look at divergence. If not, then move on. It takes me 2 minutes to go through the 4 indexes and nothing else. And by 4 p.m. Eastern, this is done. Right? This exercise is done, and rinse and repeat. The following day is another 28 days I'm looking at. So people who have a regular day job that can spare 30 minutes throughout the whole day, this is great for you. Even if you're a full-time trader and don't want to look at charts all day, this is great for you. And for anybody who is new at trading, this is one way to get into trading without having to quit the current source of income that you have. You can just keep doing this and looking at trades. So moving on then, as we look at next opportunity, and these opportunities come often because it's a 30-minute chart. It might look like a lot of days, but between this entry, which we have made nice gains on, so that was, for example, February 23rd. The next opportunities we will find will come, like less than 10 to 15 days later. So here, what do we have here? Here, price is making lower lows, but our MACD is pretty much flat. So this tells me it's time to consider getting in. And where I want to get in is when price breaks that low bar. So this is where I want to get in. This is where I get in. This is where I have my stop. And now for my exit, I come here and do recent high to low. 100% is my exit 1, and I write the rest, but my stop has moved up here. So as you can see, this whole trade is a gain, because this is where I entered, right? This is the zone where I entered. This is where I took off 50% of my position, and this is where I take off the rest of my position because I'm stopped out, right? I'm stopped out because I'm manually watching it, but because this is an overnight trade and I know it has hit a low, so my exit for an option, I have to wait for the market to open. And so when the market's open at 6:30, right? At 6:30, I'm exiting the other 50% because market has already shown me some weakness. Somebody can say, well, you know what? We recovered. So we didn't really stay to those lows. That was overnight lows and we recovered. And I want to write it up and have my next target be this zone. That's perfectly fine. It's all about risk management. It's all about how much initial capital you've put into this play and how much risk is into this play. If you're managing your risk properly, if it's not heavy, if you can sleep at night with this position on, you don't have to day trade it. You can just swing trade it and be able to sleep at night without thinking about anything, then that's the right position. And so with that right position, you can say, it's okay, I have seen this recovery and I want to take advantage and at least, be able to see if I can get up here to this zone, or if I can't, if I can't break this zone, at least then my stop is somewhere here. So this stop is better than this stop, I agree, but this stop for me is a sign that says, hey, it's time to get out. So pretty much 100% of my position is out here. So if you had gotten out the second one at this stop, which came later in that day, I actually made a little bit more money here because theta decay is going to start eating throughout the day as well. But this is not a big deal. I'm just showing you some example areas where you can take off your position, and price could have also rallied, right? Price could have continued to do this, and you didn't have the stop loss, so your exit would have been better. So all of these are valid. It's how much you want to risk, how much you want to manage it, and how much time you want to spend at each one. But at least you have target one is set. Target one is the most critical one, is set, and then you're closely monitoring every half hour where price is so that you can exit. So let's go to the cues and look at another example. We can go to any time. It doesn't have to be past, present, future. You can just go to any time. And so here, price went down. Our MACD is down, so that's not nothing there. Here, same thing. Price is going down, but here, you see where in this particular instance, this is doing this, and this is doing this. But here, this is doing this, this is doing this. Boom, this is my entry. Now I found an entry. So when price breaks this doji bar, when price is at high here, this is my entry. And for my exit, recent highs to recent lows, exit 100% at 50% at the highs here, and write the rest. But tight stop loss, so we were stopped out here. We were stopped out because we tagged it and we failed and we closed in this zone. So after we tagged it this hour here, because we closed in this zone, the next 50% is out. So here's where we entered. Here's where we exit one. Here's where we exit the second one because of our tight stop. Price continued to rally. I am not looking at that. I am not regretting any positions because I have my rules, and these are my rules. 50% out here, and if price doesn't continue to have that bullish momentum, I am out. There's no discussion about this for me, and there's no regret in any position. And you take 10, 20, 30 contracts, this $1, $2 movement has a lot of returns. So it's not about the small movements. It's not about the big gains. I just want to keep turning and turning and doing so. So this is a simple way how I'm looking at entering them. And now I want to show you just one thing here, why I decide not to take the put side yet. Because we're in a strong uptrend. We're in a very strong uptrend. I don't know. I have no way of knowing if this is a deep pullback. I have no way of knowing that. And when price, for example, right here, this is a very good example, very, very good example. When Price between Friday and Monday has higher high, but MACD has lower high. This is classic example of a good divergence. I am normally wanting to enter this to the downside, but because we're in a very strong bullish trend, I don't know the strength of the pullback. So for me, my entry is because it's at the break of this bar here. And look where price ended up being. Price went from 331 to 329, the $2 move. It's a lot of movement for a lot of contracts, but because I don't know the depth of this pullback, I just prefer not to take this pullback. People can easily scalp it. If you just say, hey, 50 cents move, $1 move is enough for me, I'm going to quickly get in and get out, great. But my preference is I just swim upstream. If the overall market is heading up, I just want to follow it heading up. I don't want to add anything else to it. I don't want to complicate it. So this is how I trade the 28 minutes a day with the divergence of the MACD and in alignment with the overall trend. And it gets stronger when we are at an area of value. I know this is where I start my thinking. So my structure, within an uptrend, we have some structure. Area of value is as we come close to areas of support and resistance, whether you draw it as a trend line or a horizontal line. When we come to those areas of support and resistance, is price reacting in any way? If I have taken a position, at 322, for example, when I get to the trend line, is price stalling or does it continue to just keep cranking? So that's why the area of value is important. Then I can execute accordingly. I can exit trades, I can enter trades, I can adjust trades, I can adjust stops accordingly. So that's why it's very key here. So I just wanted to give you this idea, 28 minutes a day for trading. You can do this. You can do this. And if you have any questions, feel free to reach out. I want to guide you to be successful. I want to show you, multiple examples if you need some hand holding. So just reach out if you need any help. With that, I wish you a great day, great success, and make some green.